All right, we're going to go ahead and get started with our panel. So I want to thank our panelists and our partners. We have three individuals here from different fund companies. As most of you know, we took, we made some brave or hard calls at the beginning of the year and really adjusted client portfolios. Moved away from traditional portfolio management, and most of our clients have some combination of cash, alternative investments, and then an equity portfolio that we have. I'm not going to get into what our alternative investments, if you came to our market outlook back in January, or you've watched any of the YouTube videos that we've put out. We go over the specifics of the different types of alternative investments. But essentially, we have three of those partners here. We're very thankful and grateful for your all's partnership and for joining us here tonight. Many of you coming from out of town to be here, so thank you. So we have Todd Starnes with Invesco. We have Lou Greco with Scion Investments and Kyle Lopriore with Blackstone. So I am going to take a moment and let them introduce themselves a little bit further and specifically make sure that you address what kind of asset class you're going to be kind of focusing your comments on tonight, or kind of how we use you in our client portfolios. So we'll just start with you, Todd, and we'll go down the line.
All right, good evening, everybody. It's a pleasure to be here. It's been a long time since I think all of us have been able to be in front of a group and speaking, so it's we get a lot of energy from that, so thank you for that. So I'm with Invesco. Invesco is an asset management firm that has lots of different investments across stocks, bonds, whether it's ETFs, exchange-traded funds, mutual funds, or other types of investments. And the areas that I'm going to be covering tonight are going to be kind of the stock market and different commodities. So I know Todd has covered a plethora of ideas with you, so I'll dovetail off of that. He's taken over our spot over there. I was the only one who decided to eat, so it's pretty good. So I'm going to continue to eat after. But I kind of keep coming back to a couple of things here. I think of the famous quote, "It looks like it was the best of times, it was the worst of times." I think about that because you could probably take that into consideration every day that you're sitting there if you do watch the market. I don't suggest you watch the markets, but people do that. And then I also remember a quote that my dad always shared with me was, when you think things are really bad, they're never as bad as you think they are. And when you think they're good, they're never as good as you think they are. So you kind of just need to have that thought somewhere in the middle. And then the last thing that I think that Todd touched on, recession. People are talking about recession this, recession that. And so I saw a few quotes that kind of made me chuckle a little bit because, when everybody says something's going to happen, it's usually not right. So Jamie Dimon, who's the CEO of JP Morgan, who, if you remember, said that cryptocurrencies are never going to matter at all, yet he now has a cryptocurrency division. He said that there's a recession warning likely in the next 6 to 9 months. Elon Musk just said the global recession could last until spring of 2024. And then Jeff Bezos from Amazon, he said batten down the hatches. Now the next one's my favorite one because Cardi B said she's gloomy about the economy. So on that note, I'm going to turn it over to Lou and let him tell you a little bit more. But we'll see you in a few minutes.
That's hard to follow, but Lou Greco, I'm with Scion Investments. Our firm historically has partnered with some of the largest and most well-known private equity and private credit managers in the world. Through our partnership with Ares, we have a diversified credit product that essentially gives you direct access to the private credit and direct loans through U.S. and European middle market companies, but we also have liquid credits and traditional credits as well to be flexible and dynamic in an increasingly volatile market environment. So we combine private credit with public credit, seek out relative value, and just try to eliminate any idiosyncratic risk or market risk whatsoever, and being patient, defensive, and just diversified. That's more or less the story of our strategy.
Thank you. Good evening, everyone. My name is Kyle Priori. I'm a vice president at Blackstone. Specifically within Blackstone, I'm part of Private Wealth Solutions. To give you a quick overview of my firm, today where we sit, we manage about $950 billion in total investor capital. That's across your four major food groups in the private market space, which includes hedge funds, private equity, private credit, and private real estate. My lane today will be in the private real estate space. Why we're qualified to talk about that today. We manage about $320 billion of private real estate globally. If you count that relative to some of the both public and private market managers, that would make us the third largest owner and operator of private real estate in the world, behind only the Vatican and the US government. So, we certainly believe when it comes to Blackstone, we have an information advantage in terms of being able to see what the world really looks like. Obviously, we have a lot of headline news and things that are out there today, so hopefully we can kind of demystify some of those things as it relates to private real estate. More specifically, I mentioned my group is called Private Wealth Solutions. Private Wealth Solutions specifically partners with a select number of advisors across the country. We're happy to count Mercer Advisors as one of those partners that we have. So thrilled to be here today, thrilled to be here with all of you, and hopefully we can answer some of the questions that you have today.
Well, I'm really glad we could confirm that fact about Blackstone being the third largest. Todd likes to mention that a lot when we are explaining our portfolio holdings. And, that's one of those things where you're like, But you've confirmed it for us, so thank you for that. So we're going to keep this, we're going to try to keep this short. I have a series of questions to ask our panelists today. If you all don't like my question, feel free to just talk about whatever you want. I've told them, it gets a little tricky when we start to talk about politics. We're not trying to, trick you guys or get you to say anything controversial. We just want to hear about how, those different asset classes, real estate, private credit, commodities, or the equity markets, how that can be affected by the midterm elections. And so that's what we're going to talk about here. If you have your own questions, I think we are going to, open it up for questions at the end. Or if you don't want to ask your question in front of everyone, I'm sure our panelists here are happy to stick around for a little bit after we finish up and answer any questions that you have one-on-one. So to kick it off, I'm going to ask Lou the first question. So, Lou, we often see a lot of volatility leading up to the election. Can you talk a little bit about why the market gets more volatile and what that can mean for allocations, both in the short term and the long term?
Sure. Well, I think the normal environment now that we're all in is very similar to what happens during a midterm election. It's a market driven by uncertainty, headlines, obviously, geopolitical events around the world, but now it comes to our front door and we're faced to confront it. We think that the midterm election might bring a little bit more certainty. It'll be a split House and Senate, and I think the market likes a little bit more certainty, and gridlock is usually better for investors. But I think our best thinking is to prepare for volatility and episodic bouts of it over the long term. So we look and we're lucky to have a more diversified mandate, and we're able to capitalize across the credit spectrum, because a lot of times where you see negative events or just sell-offs at the fixed income or bond markets, it's usually technical in nature, and good managers, credit managers could select and see through the noise to find good quality. So we look for episodic periods of volatility as opportunistic investors, but we'll always preach patient, defensive, nimble capital, and being incredibly selective is probably the most important part of being a lender or a credit manager. And similar to Blackstone on the credit side, Ares is probably the largest non-bank lender in the US and also Europe. And their number one job is to turn down deals. So they do the most because they see the most, but they turn down an incredible amount. And we think for any credit investment, any fixed income investment, you should be looking under the hood and making sure that there's covenants and there's structures in place to protect the end investor.
I think that's a great point. That's a question I feel like we get a lot when we're meeting with clients, because here we are saying that we think we're in a recession, economic times are going to get tough, and a lot of times we get clients that say, okay, well, don't we think that some of these, loans are going to go bad, that sort of thing. But your all's company does a great job at underwriting these loans. You have a long track record of, doing this and, choosing the right deals, so to speak. So I think that's a great point. Okay, so our next question, I'm gonna let any of you all answer or all of you all answer. So as Todd kind of talked about with the polls and the data, it looks like we are going to end up with the Republicans taking control of the House and potentially also taking control of the Senate as well. So with that being said, can each of you just comment on how a split Congress or a Republican-led Congress could impact your respective investment classes? Todd, do you want to start us out?
Every time you say Todd, I don't know which Todd you're talking about.
I'm only talking about you
Okay.
while we're up here.
Okay, all right, that's fair. So
Todd Mercer has to stay quiet.
So if you, can you do that? All right, that's good. But just a few quick comments. Number one, general thoughts on the market and commodities in general. So there's three primary drivers for what we're looking at going forward, right? We have to come up with a terminal value of what the Federal Reserve is going to do when they raise rates. What is going to be the last number they land on, and then how long is that going to last, right? That's a big deal for all different types of businesses involved. Secondly, what's the outcome from the war in Ukraine? Like, what is it? We don't know this, right? And then what is the fallout from inflation and from the rates? Inflation is a backward-looking statistic, so it's almost like the Powell's trying to drive by looking in the rearview mirror. It's a very difficult job, right? So we have to focus on that. And then with commodities, the other asset class that we deal with, there's so many different potential rabbit holes that we could go down based on these other statistics and metrics that we're talking about, but I'll cover some of those. One stat, I know Todd covered this regarding the stock market, regardless of who has won, regardless of whether it's been split, regardless of whether it's been one-sided or not, there's never, since the 30s, there's never been a time after the midterms when the market's been down. In fact, the average return is almost 16%. So I'm looking forward to that statistic continuing. I think that'll be phenomenal, and we can experience that because none of us are happy with what we've seen, except for the fact that you get some great buying opportunities right now. I mean, what other asset classes do you get to see go on sale, right? I mean, we all want sales, but yet we want to buy stocks when they're at the top. It's just human nature, right? So let's think about that. And then commodities. So if you talk about if we have a split situation there, so there's a lot of different cars out there now, right? You got combustion, you have these electronic vehicles. Well, I think if you have a split or Republican-led, you'll see less of a push for those. I don't know. I worry about what's the power grid going to look like when everyone's trying to charge their cars, right? What's going to happen then? You might see rolling blackouts for that reason. So if it's split, you'll also see the U.S. bringing back the fossil fuels to the U.S. So we're a net exporter. From an agricultural standpoint, which is a big deal, there's a farm bill that's in Congress right now. I don't know how many of you are aware of that. It's this $430 billion bill that's got 12 different titles into it, which I don't even know what that means, but it's all about supplemental nutrition programs, crop insurance, conservation, trade, research, rural development, forestry, etc. I'm sure there's a lot of other stuff built into that, but if that were to end up, if we do have what we think we're going to have by the predictions, then a lot of that won't pass. It'll have to be restructured. So that's what I have. I'm pretty sure I'm handing this to you.
Sure. All right. So split Congress. I'll go back to kind of where I started. Right, Blackstone today manages about a $320 billion real estate portfolio. We manage $320 billion for a reason, right? Because we've successfully delivered for our LPs and investors since the early 90s when we started. We've managed in real estate through all sorts of different cycles, both politically, market, and otherwise, and we've delivered net IRRs or net returns of 16%. So the reason for that long and kind of arduous preamble is we've been through these types of cycles before. We've built an all-weather portfolio that really you wouldn't expect to see any sort of negative impact on it, whether Congress is split, divided, whether it's all, cohesive. The fundamentals in real estate right now are incredibly positive, and you have not had the traditional cycle that you've seen where you have an influx of cranes and capital to come in and create new supply in the specific markets. Now, I know there's a question later on that we'll get to on some of the specific sectors and underlying of where we allocate. Not all real estate is created the same, but what I would say is, regardless of what happens with midterm elections, I think our portfolio broadly is set up very, very well. And then more specifically, private real estate as an asset class has a history of being very, very resilient in periods of inflation. And what you see is a cost to build new assets that are up dramatically. You see a cost to service assets that require a lot of new CapEx has gone up dramatically. So when you have a stabilized cash flowing property that's well maintained, you're in a very good position from a margin standpoint. And there's nothing at this point that we look at in the political world or otherwise from a market standpoint that really says there's going to be a ton of challenges. Are there headwinds in the environment today? Absolutely. But it's not something that you can not navigate yourself around with good management, good underlying structural fundamentals, and really being a balanced manager in the space. So, again, I guess the short answer is no, there's really nothing going on the political side that I think would really impact what we're seeing in the private real estate space today.
I would largely agree. I think I accidentally touched on this on the earlier question, but I would just echo the private markets are incredibly resilient in general. During the last recession, it added 2 million jobs. Public sector shedded nearly 4 million. If it was its own country, the middle market and private markets would be the fourth largest economy in the world. So I think you have an extra layer of insulation, if you will, in the event that there is some sort of drastic recessionary environment, and just prepare for episodic volatility over the long term. I think the addressable credit markets are growing, regardless of what happens in the House and Senate. Some of the regulations on banks are here to stay forever, and I think that firms like ours will continue to play a more pivotal role in credit and fixed income more general, whether that's buying good bonds when they sell off, whether it's physically originating a loan to a private company or somewhere in between. I think that's here to stay, and every day normal investors are getting direct access to some of the best managers in the world because of it.
So this might be a little redundant based on some of your answers, but is there any potential outcome from this election? So, maybe it's not a split Congress or Republican-led Congress. Is there any potential outcome that could substantially change, the underlying investment thesis of your all's investments that we use, or just portfolio strategy in general?
So from an equity standpoint, from a stock position, there's not. I don't think there's anything that's going on there. It's all based on what the Federal Reserve decides to do, and when that changes, there's this phrase that I'm sure you've heard: "Don't fight the Fed." Well, if you're fighting the Fed while rates go up, you're in trouble, because typically stocks are going to drop when rates go up. It's harder for companies to make money. They have to use the interest rates that are out there to capitalize the different projects that they have, and so on and so forth. So, I think what will give the greatest boost to this is what, I mentioned the terminal rates. What's the end rate that the Fed's going to have? How long is that going to last? The geopolitical risks and inflation and where we are now. I have an interesting quote I found. I don't want to mess it up, so I saw it, and it said, as long as the official policy is to make the stock market go down so that people are less wealthy, so that they buy fewer things, so that prices stop going up all while doing nothing about fiscal policy, we believe the current posture is to be bearish on stocks and bullish on inflation. That's an interesting thought. Again, if everyone's thinking that, it probably won't happen that way, but it is something to consider. So, that's the stock market. With commodities, I think we're going to discuss that a little bit more in depth later, but rates and the dollar are a topic. Todd mentioned about dollars and how they affect oil and other commodities. I'll discuss that in a little while. And then metals. So that's a commodity, and if we're in a position where electric vehicles may or may not be the top topic, that could change the price of metals. With commodities because you have these rare earth materials that are used for the batteries used to create what makes the cars work and go, and that can be an issue. So if the Democrats happen to be in, you're going to find a lot more clean energy bills. If the Republicans are in place, you're going to find, again, we want to be a net exporter of energy. You'll probably see some different energy, I guess, I don't want to say coal mines, but you'll start seeing some other things come back online that were maybe shut off. And what's an interesting point is, you may or may not have heard this, but the best hedges, the best way to protect against inflation is to be in the stocks and to be in real estate. So it's the best places to be because they tend to continue to make money off of those things. People have to pay rents, and so I just wanted to piggyback on that.
Great. Do either of you all have anything you want to add?
Yeah, I think that was a great point. And beyond it, we talk about macro trends, right? And you think about the real estate space, and I've said real estate a million times now, but it's really specific to certain sectors, right? Because not all of real estate is created equal. And when you think about Blackstone, we invest along what we call mega trends or mega themes. And a lot of the mega trends and themes that we've seen are ones that you've all seen in many ways in your day-to-day. The digitization of the world. Well, you think about how that impacts real estate. How does the digitization of the world impact real estate? Well, it has a negative effect on office, right? And you've seen it because of COVID. More people can work from home, less demand for office space. So where has Blackstone moved our portfolio to? A decade ago, the two largest areas we had exposure to were office and hospitality. Today, where we sit, we have virtually zero exposure to office. So the underlying fundamentals in that asset class are really challenging. And regardless of what happens in the election, those trends aren't changing. You're seeing it today, right? Downtown areas are becoming a little more of ghost towns because more people are moving to the suburbs. There's fewer people in the office, which means, again, the amount of space that's needed is less so, which means the demand for tenants is less so, which means your ability to control leasing spreads in office is lower, right? Now you juxtapose that with other areas of the private real estate market that are far more better positioned for these megatrends, right? One of the megatrends that we've seen is the undersupply in U.S. housing, specifically as it relates to multifamily units. We have underbuilt in this country to the tune of about 5 million unit deficit today, right? So we need 5 million units of new housing today to meet up with existing demand. And we know that supply is pretty clear-sighted. It's 3 to 5 years out before you see that. So what you have is a structural shortage on the multifamily side. You have more people moving to suburban areas. So if you have multifamily garden-style apartments in suburban Sunbelt locations where the demographic trends are in your favor, you're able to control occupancy, which allows you to control releasing spreads. Think about that digitization trend that we talked about. How is that impacting how you spend on goods, right? The Amazonification of the world. Everybody these days has 1 or 2 Amazon packages or something otherwise that shows up. Supply chains are dramatically changing, right? You've seen it move from a regional impact to more of a local impact. When you think about your e-commerce giants that are out there, 60% of their costs are associated with labor and transportation. 5% are associated with rent, which means what they want is last mile infill warehouses. So when you think about where our real estate portfolio is exposed, we have multifamily on the residential side, and then on the industrial side, we have last mile logistics warehouses. There's more and more a trend towards retail being online. There's more need for industrial warehousing space close to the consumer, which means your occupancies are high, which means you're able to control releasing spreads. So when we talk about midterm elections and the impact of it, these mega trends really aren't going anywhere, and they've been in place for 5 years, if not longer, and the trends on those are going to continue into the future. Obviously, you won't have the COVID acceleration as it relates to e-commerce, but it's going to continue to eat into the overall retail pie. So for us, it's not just about private real estate being an inflationary hedge, it's about where within the private real estate space you have those assets located. Because you can be in the bad neighborhoods, quote unquote, as we call it, areas like office and other places that are challenged versus the good neighborhoods, and you won't have as good of an experience. So I think it's a lot about manager selection and being along those mega trends more so than kind of following the winds of where politics go.
That's a great point. We like to keep tabs on what's going on in not only the U.S. but like here locally, and we got the inside scoop that our former colleagues over at Merrill Lynch, they now buy lunch for the office was it every day? I'm not sure if it was every day, or once a week or something.
Every day.
Every day to try to get people to come into the office, and it just gets thrown out. So Todd and I were meeting with a client yesterday, and we were talking about Blackstone and the investment, and they said, well, the pandemic, we don't want to invest in offices, and we're like, that's 2-3% of the portfolio. That's not where your investment is. So that's a great point. Lou, did you have anything you wanted to add?
Those are great answers. No, I think we move on.
Okay, great. So, Todd, you kind of led me into the next question with your answer. So, Federal Reserve policy, that is really, in our opinion, what has been moving the market this year, moving the economy this year. So, Federal Reserve policy, monetary policy, that has had the biggest impact on things this year. But the Federal Reserve's actions, those are supposed to be completely independent of, political motives. Their decisions are not supposed to be based on who's in party or, who wins elections. What does have an impact from a political standpoint is fiscal policy, though. So we've talked about how we think these elections are going to play out. I would like to ask our panelists if you all think there are any particular fiscal policy actions that result from the outcome of these elections that impact your asset classes. So I'll leave it open to anyone that would like to start us off.
First off, who only gets 2 packages a day from Amazon? If I could get down to 2 packages, that would be awesome. So, all right, so fiscal policy implications. So if you have a split house, split Senate, or split set of houses, what's going to happen is you get gridlock when it comes to different spending environments, and you don't just get every bill that passes. So when you get gridlock, it reduces the spending, right? And so it hopefully reduces the deficit a little bit here. But if you have unlimited spending, which we've kind of seen going on here, your deficit climbs, you've got interest rates which are through the roof, and the cost of that debt is increasing and increasing. Now we don't know what the implications of that are. We just keep the proverbial kicking the can down the street. We don't know what this is going to mean. I think we know what it means now, right? We're feeling the inflation from it, so that's an implication from the increased fiscal policy that we've had. But it's really difficult to estimate what that's going to be going forward. It's difficult to estimate what we're going to see going down the road. If we do have less spending, then we should feel comfortable that in time inflation is going to go down.
Yeah, within the credit or I guess broader fixed income space, 2020 and Fed stimulus, buying back of risk assets. It really propped up some of the most risky parts of the credit market. We don't think that pain has necessarily been felt. So doing your homework on credits, making sure that borrowers are worthy of loans, they have strong balance sheets, fundamentals, receivables, inventory, cash flows, etc. is pretty much the name of the game. But with gridlock comes maybe some more confidence, and you may see the market rush to a more risk-on environment, which may prolong what's under the hood of the credit space. So doing your homework, making sure that there's protections in place, and there's ample capital and defensiveness in underwriting. We think that's going to define performance over the next 5 to 10 years. So just be selective, patient, and do your homework ultimately.
Yeah, so I'll answer this in kind of a long-winded way, so bear with me. But inflation's here, and it's persistent, and it doesn't seem to be going anywhere. And the current Fed is very, very aggressive and hawkish about looking to stamp that out. And I'll quote a few stats for you. So at Blackstone, we were building our portfolios to be inflation resistant a little over 18 months ago, because what we started to see was a lot of inflationary pressures across the business units that we manage. When you look at the Fed and the way that they calculate CPI, there's a lot of we think challenges in that, specifically as it relates to the shelter component. Does anybody know how the shelter component of CPI is calculated? Good. It's called owner equivalent rent. The Fed basically calls 8,000 random households and asks them a series of questions. Again, if you get a random telephone call on a landline and they ask, if you were to rent your property back to yourself, excluding utilities and what's in it, what would you charge yourself? So think about the inefficiency of that, right? Think about the way that inflation is being undercalculated. The theme that I have behind that is that inflation is here. The Fed is here to stamp it out. Fiscal and monetary policy are going to be a lot stronger, a lot more aggressive for a lot longer in our view. And when you think about not just on the monetary side, but on the fiscal side, we bottomed out on a Fed to, or a debt to GDP ratio here in the U.S. in 1981. That has quadrupled since 1981. So we have an incredibly bloated balance sheet at this point. And what you're starting to see is the Fed let that roll off. So in the next 3 years, 50% of the Fed balance sheet is going to roll off. And they're going to refinance that at a much higher rate. The average coupon on the current federal debt is about 1.7%. The weighted average maturity of that is about 6.5 years. And again, I mentioned that over the next 3 years, a good portion of that is going to mature. They're going to refinance that at a higher level, which means that the spending side really has to fall because of that. So.
Great, thank you. This next question is for you, Todd. So is there any outcome from the midterm election that would favorably impact specifically the commodity markets? I'm really thinking, in terms of the commodity markets, what we've seen really have an impact on those prices is the situation with Russia and Ukraine and how the U.S. kind of plays into that conflict. So can you talk a little bit about that?
Yeah, sure. So it's uncomfortable for everyone to see what goes on TV. You see what's happening over there, and it seems like there's not going to be any end in sight. Like, why did it even happen? But some people that I do a lot of research into this because I care about the commodities space, and some people are saying that Russia can't keep going on like this, that there's a tremendous problem with morale, that they're just a paper tiger, that, I don't know, to me it seems like when you have a country that big and they've got potentially unlimited resources to be able to just pound another country like that, how does the other country not surrender? Well, there's got to be a lot more going on if they haven't surrendered yet. And the morale is horrible with Russians troops. Russians troops are coming back, and you unfortunately you just see what's on the news. So I don't think that it's going to hold up as long as I think a lot of people do, because Ukraine is making gains, and then you have the issue of Ukraine and all the grains. You know why their flag is the color that it is, right? It's blue for the skies and yellow for the grains. So they're a tremendous exporter of grains to the world. But inflation is so much more of an issue here, and this is kind of one of these little rabbit holes that you go down, because if you start thinking about it, we have the dollar. Todd alluded to the dollar. So let's talk about oil for a minute. So oil, let's just use round numbers. If oil here is $80 a barrel, with the way that the dollar has increased in value, and it's going up, why? Because the Fed's raising rates, so the dollar's going up in value. It's causing other economies, because of exchange rates, to have to pay a lot more, like maybe $120 a barrel. So we're paying 80, they're paying 120. So what's oil used in? What about natural gas? What about all this? Well, what else uses natural gas in the production of that commodity? Well, fertilizer. Okay, so fertilizer costs a lot more, right? So now you've got, what does it cost to fertilize crops? Well, what's causing the price of agriculture going up? You all see it at the stores, right? You see it. You see shortage. Well, I don't know if there's a true shortage, because if you want to buy certain meats, you can pay for it. You just got to pay up. If you want to buy other vegetables or whatever, you can buy them. You just got to find them at different places, and you pay more for it. So, that's kind of an issue that really comes into play there. But as far as the midterm election outcome that could favor it, I think you're going to have to find somebody in there that potentially that Putin's scared of, because I don't think he's worried about anyone that we have currently that's in there. The other thing that is scary to think about is that how does he come out of this? There's not one scenario where this guy is going to come out of this and have any credibility with the rest of the world. So, there's there's just a lot of unknowns in this space. So maybe getting back to the question that you asked, I don't know what the favorable scenario is, but those are some of the situations that we're looking at. As long as the dollar's high and natural gas prices are high, and they're talking about, is Russia taking certain pipelines offline, and are they going to ration things over there? I mean, we won't feel it over here like they do. We're paying 8 and change, I think, for natural gas, and they're paying 20 something. So it's we don't feel it like they do. So hopefully that answered your question.
That's great, thank you. We're going to switch gears a little bit, and this next question is for Kyle. So you've touched on it a little bit. One of the reasons we really like the Blackstone investment is that it is so heavily invested in multifamily housing and the industrial warehouses space. But kind of to the same spirit of the question for Todd, is there anything from the election, any potential outcome that positively impacts the private real estate market?
I don't think so, and I don't think there's one that negatively impacts it either. I think that, when you think about real estate, it's really a supply-demand game, right? And I kind of alluded to it earlier. We have a real lack of supply in 2 specific areas in the private real estate space, industrial and multifamily, and at the same time, the demand is through the roof. So at this point, when we think about where the fundamentals are in private real estate, they're incredibly strong. When you think about the historical cycles with private real estate, it follows a pretty similar track, right? We'll start with the growth side, right? There's growth in specific markets. You see rental growth going up, and then what you start to see is what we call cranes and capital come in. What that basically means is new development, new supply hits the market, it increases the number of units, and then eventually it drives down the overall prices, creating recession, and then it starts another cycle beyond that. When you think about where we are today, I alluded to it earlier with the deficit we see in multifamily and the challenges that you see in industrial. We have not seen that excess supply built up anywhere in the system. So, from a challenges standpoint, you don't see it. From an opportunity standpoint, what we look at is where the world sits today, right? When we look at our portfolio in particular, right now, we have about a 20% upside as our leases start to roll and reset to market. So 75% of our doors will reset over the next 12 months, which means we are going to be capturing market rent growth. So you're going to see the portfolio's net operating income increase. And to put that into context, when you look at multifamily, what you saw in the first 6 months of the year was same-store NOI growth or same-store rental income growth go up over 16%. Even if that number moderates, and that number historically tracks 1 or 2% over inflation, so let's say we get back to 2 or 3%, which certainly seems unlikely on inflation, you can expect that to be 3 or 4. Even if that moderates, the portfolio has upside built in as we capture what we've seen over the first 6 months of this year and really the last 12 months prior. So the question I would have is, on the upside, is are you able to actually capture those rents based on where people's earnings are? And what you continue to see that's been a stickier part of where inflation could be a challenge is the wage inflation, right? And you've seen that coming in with reports of 5 to 6% wage inflation. What we look at is rent-to-income ratios on our portfolio. Right now, the rent-to-income ratio and where BREIT's allocated is about a 24 to 25% metric. Affordability in the U.S. generally sits at about 33%. So what you have is enough wage support behind it to continue to see that releasing spread go up. So at this point, I think the election, as you've probably heard me say, is probably a moot point whichever way it goes. The fundamentals in real estate are so strong and the underlying growth is still there as it relates to releasing spreads.
Great. So to kind of flip the coin there, we kind of talked about upside, from the outcomes of the election, and maybe not necessarily from the election, because what I'm hearing all of you say is, the election doesn't really have a big impact on your respective asset classes. Commodities, private credit, real estate. There's other factors that affect those, but not so much the noise from the election. But I want to hear what you all think. Maybe the biggest risk is to your respective asset classes. We've had a significant downturn in the equity markets. The Great Recession, even though it was over a decade ago. It's still fresh in people's minds. The situation with the pandemic and how scary that was from the unknowns. That's fresh in people's minds. So is there any black swan event from something that could impact your respective asset classes that our clients should be on the lookout for or concerned about? Do you want to start us off, Pat?
Yeah, I've got the mic. I'll start. Probably won't be a surprise given I keep talking about supply and demand. The biggest, and it's not a black swan event, but the biggest really challenge you would see out there would be an influx of new supply. That's something that you always watch because again, what you have is traditionally line of sight, right? Development generally takes anywhere from 2 to 5 years in a good environment and a little more challenge beyond that. So what you really have to see is a glut of new supply hit specific markets, suburban Sunbelt locations, or on the industrial side. What we see right now are challenges to new supply that really come down to, one, you think about inflation, right? Inflation really impacts on the development and the build side. If anybody's done anything to their home in the last 6 to 12 to 18 months, you've seen the challenges with prices there. We just finished a patio. We're waiting. I feel like it's been like 12 months that we've been waiting for, furniture to arrive. Now, the supply side, right? So when you have all the goods that you need to build properties, that inflation will moderate. But I mentioned before the wage inflation challenges that really impacts developers as well. So if you think about the way things have gone, new supply is something we watch out for. But it's 40% more expensive to build this year at this time than it was last year at this time. So what you have is a lot of things are frozen in place, and you don't have that influx of supply that could come to market. But that's really what you want to watch out for is new supply. And then the second one would be affordability, but we kind of covered that in the previous one.
Thank you.
Yeah, I mean, I don't think there's a black swan event that we foresee. And we ultimately try to eliminate any, again, idiosyncratic risk, geopolitical risk, headline risk from our underwriting process. In private credit and lending, it's a little less sexy, if you will, but it's more of a straightforward formula. You lend money to good companies that pay you back, you do it again, and usually, when you do big deals, you get a discount up front, and the deals mature at par, and you're getting a fee for doing it. So, if anything, the environment is becoming a little bit more efficient for private lenders, direct lenders to step in and fill the role of the banks that are, becoming more and more levered and less able to do things like, extend capital and even buy bonds or make inventory. So you're seeing private equity, private credit firms really step in and, take advantage when there's a lot of pain. So just, having the capital to deploy when things turn in real time is pretty much, what we're looking to do. But again, we turn down deals more than we do. For every 100 deals that we see, we do 3 of them. And, that's pretty much going to be the case in perpetuity from an underwriting perspective.
Thank you.
Hey Kyle, you can order furniture on Amazon.
It's industrial supply chain.
Okay.
It's been a big challenge.
So you can get 2 packages in a day. So. All right, so you like ending on a sour note? Is that what you want to do? Because I have some black swan events that you could think about here. So a lot more will affect our markets than will affect their markets. So the first thought is, what if there's a cyber attack, right? Like we haven't experienced that. What if that happens? That could be something that could freak us all out, right? That could come from another country hitting our power grid. That could come from solar flares. That could come from whatever you might want to think about there. On the precipice of the news is China invading Taiwan because of what they've got going on over there with the semiconductors and the chips and whatnot. I thought of this one. What if Biden and Harris are in a concurrent accident and Pelosi becomes president? So that's a black swan event, right? Putin in a nuclear war. I mean, that's a thought. If there's an oil shock in some facet and prices go through the roof on oil and gas, because we really haven't seen, it's gone up and it's gone up on a huge percentage, but it's not really affecting most of us here. Some unknown pandemic happens, right, that we don't know. If China and Russia attack the US dollar, that's been kind of a fear for years and years and years that they're going to create take the US dollar as a reserve currency out. And don't forget that China holds $1 trillion of our debt. So that's a big case. But I don't, the whole point with black swan is you can't really see it coming. You don't know what's going to happen. Are these things likely to happen? No, they're what they call tail risks. If you look at a distribution curve of things that could happen, they're not likely to happen. And the great thing that you have with this group is that they've been talking to us for a long time about ways to protect your portfolio. Todd has been very bearish on this market for a while, and Andrew's put a lot of things in place with the portfolio that have that have really protected and helped you through these times. So how's that for ending on a happy note?
Well, we wanted this to be, truthful and open, so we'll take the good and the bad. But to your point, Todd, we have, we feel like we've really positioned portfolios to protect clients during this, kind of economic season that we're in and bear market. And we're not, like you said, Todd is generally the ultimate optimist. But we knew that when the Fed, took the punch bowl away, that was when the market was going to turn. And so, that's where we're at. And we had prepared in advance to be able to go in and make changes to client portfolios to get more conservative. And on the flip side of that, we're already having discussions about how we get back into growth assets, how we position client portfolios to take advantage of the great buying opportunity that we're going to see. And make our clients, a lot of money on the other end of this as things turn around. So we're not, we try not to be behind the curve. We try to be forward looking, whether that's to a bear market or a bull market, and the different potential things that can happen.